For decades, a classic 60-40 portfolio, 60% equities and 40% bonds, has served as a model for balanced investing. During periods of market stress, the bond portion often cushioned equity losses, while equities drove long-term growth. Although evolving macro conditions may challenge this model, the core principle remains. Asset allocation is the most powerful lever in controlling both risk and return across an investor's lifetime. Asset allocation is the process of dividing an investment portfolio across different asset classes, such as stocks, bonds, cash, real estate, and commodities, based on the investor's risk tolerance, goals, and time horizon. It is the single most important decision in long-term investing, accounting for more performance variation than security selection or market timing. Equities. High return potential, volatile, ideal for long-term growth. Bonds. Income generation and capital preservation, lower volatility. Cash. Liquidity, no growth, vulnerable to inflation. Real estate. Inflation hedge, income through rental yields. Commodities, for example, gold. Crisis protection, non-yielding, volatile. Each class behaves differently in various economic cycles, which is key to diversification. Conservative portfolio. 20% equities, 60% bonds, 10% cash, 10% gold or RE. Balanced portfolio, classic 60-40. 60% equities, 35% bonds, 5% cash. Growth portfolio, 80% equities, 15% bonds, 5% alternatives. All-weather portfolio inspired by Ray Dalio. 30% stocks, 40% long-term bonds, 15% intermediate bonds, 7.5% gold, 7.5% commodities. ETFs, exchange-traded funds. Efficient, low-cost exposure across asset classes. Index funds, ideal for long-term passive investing. Target date funds, automatically adjust allocations as you near retirement. Model portfolios and robo-advisors, pre-built and rebalanced portfolios for various goals. Multi-asset funds, professionally managed solutions with built-in diversification. Portfolio weights change over time due to market performance. Rebalancing involves restoring target allocation by selling overweight assets and buying underweight ones. Rebalance frequency, quarterly, semi-annually, or based on threshold bands, for example, 5% deviation. Review annually or after major life market changes. Asset allocation is your blueprint for wealth creation and risk control. There is no perfect mix. Tailor it to your goals, income needs, and investment horizon. Use diversified instruments like ETFs and disciplined rebalancing to stay on track. Your portfolio is your plan for financial freedom. Build it with intent, monitor it with discipline, and trust it over time.